Our first topic of three really cool topics, I think, which will generate some cordial and heated discussion, is investor attention and municipal bond returns. And presenting the research is John Hunn from the University of Georgia, after which Brad Wendt from the Department of Treasury will come up to discuss the work. Thank you.
Thank you very much. Awesome. Thanks. I'll see whether I have a laser or not. My parole officer's a little more forgiving, I think. But thank you all for the opportunity to present this. It's a paper on attention and bond returns. The big picture here really is stated in very academic terms, and it's sort of how informationally efficient, which means one thing in sort of academic ease and another thing to lots of other people. So I kind of revised our question a little bit to put it into better context, which is how do investors in municipal bond markets use readily available information from other markets? And in other words, another sort of, I used to have a practitioner type job as well. And so one thing that we always talked about was silos, information silos. This is sort of how informationally siloed the municipal bond market was, at least during the financial crisis. Our answer, in case you want to leave early, you want to do anything, our answer is no. It is our sort of papers, hopefully civil finding that at least through the crisis, the municipal market remained very, very segmented from other markets that provided information that should have been could have been easily transacted upon. And in particular, what we're going to do is we're going to use something that was talked about in the last discussion, which was the implosion of the monoline bond insurance market. And we're basically going to do one thing and one thing only, a simple thing. We're going to compare the returns of insured bonds with the returns of uninsured bonds and see what happens when the market market has different information about the health of those insurers. So what do you think our contributions are? We hope, again, should have put I hope up here. We hope this is a clean and rigorous analysis of what type of shocks muni investors respond to, whether they look at sort of stock and CDS and other types of markets to bring them information for trading, or do they sort of rely much more on ratings? Again, a topic that we sort of just left, and I'm going to pick up on it again. It turns out that equity and CDS markets seem to give information that should have been acted on and in some ways did not seem to be acted upon, both by retail and institutional investors. Changes in ratings do tend to prompt some selling. That's primarily by institutions. Retail investors tend to sort of not change their perspective as these bond insurers are imploding. And like I said, the market remains segmented. We have some backdoor contributions that we won't talk a little bit too much about. It turns out if you're a AAA insurer, insurance is actually kind of valuable, and we'll show evidence that underlying rated bonds have very similar returns when they're wrapped by AAA insurance, and then only when that AAA value of insurance disappears do the returns begin to split apart. And then we also do some backdoor type stuff, which I'm not going to touch on a ton here, which is dealing with a lot of the complications and heterogeneity and illiquidity in the market. So we need some sort of events, right? I told you this is going to be an event study. We're going to see what happens. And what's lucky for us, I guess in some ways, unlucky for others, is that the rating agencies are somewhat slow to the switch here. And effectively, we have a downgrade date. I'll use my laser, I guess. Somewhere here. Anyway, my parole is a little more restrictive than I thought. We have here. Here's where we call the distress date, right? Here is where where the insurers are downgraded. This is a plot of the stock prices of MBIA and AMBAC, and what you can see is that they begin losing significant market value through here. And what's nice about this for us is that we're going to call one of those things the distress date, when CDS and stock market investors seem to be saying these insurers are not only not AAA, they're functionally bankrupt. And the rating agencies downgrade about 7 to 8 months later. And so we're going to use the sort of differential behavior within there to check and see how the returns on an insured portfolio and an uninsured portfolio differ. Did people know that the insurers were kind of circling the drain in 2007? Well, people were certainly telling them, right? So Pershing Square Capital put together a 145-page PowerPoint presentation that was widely circulated in Reuters and the FT, saying that MBIA is going to be bankrupt by second quarter of 2018. Of course, people are going to take that a little with a grain of salt because Bill Ackman was short billions and billions of dollars of MBIA. So, but there's a lot of analysis in this thing. More importantly, what you can see, we pulled from MBIA's 10Ks and things like that. You can see that they are loading up on structured products, the top line CDOs, right? And keeping their sort of bond market business very, very similar. You can see the drop in the market value of their equity from almost 10 billion to 2 billion, using some sort of a structural model of distance default, sort of like KMV would use, to imply a probability of default. This leads to a 17% probability of default, which is somewhat associated with like a CAA rating at the end of 2007 rather than the AAA rating they were carrying. We steal a little bit from a paper by Creel, Gramercy, and Say, who use a super complicated, best way I can describe it, way of implying ratings from CDS spreads. And one of their examples is AMBAC, where they show that AMBAC is effectively defaulted by the end of 2007 based on their sort of CDS clustering of stuff. So we feel like there's a lot of distress in 2007 people should have picked up on. Here's a quick glance at our data. We use Mergent like lots of other people. One of the things that's very, very careful to note about Mergent is that it does a very bad job of telling you who's insuring what. Because it overwrites the insurer field. So we go back and resupply it with the novated portfolios of all the bankrupt insurers, FSA and FGIC and CFHG and Radian and all the other ones. So we get a better picture of who's actually being insured by whom. Right, so just a caveat: if you want to go back to the Mergent and use the insurer stuff, it's kind of a mess. The ratings are not, there's no ratings history there, so you need to come up with your own ratings history. Kim's co-author Ryan has a very, very large and sort of comprehensive ratings history pulled directly from the websites using lots of, I don't know, high-tech stuff too, that has Moody's and S&P ratings for everything. So we add those in. We then add those to every trade of every municipal bond security tracked by MSRB and piece these things together with some CRISP and some Bloomberg and mutual fund holding data. So it's a pretty comprehensive data set. So we can say every bond, almost every bond that was issued and almost every trade of every bond. And the reason that we need all this is because we have to do something that most people who do these things don't have to confront, which is that this market is highly illiquid. So one of the issues is that we have to create our own bond indices. And creating indices out of very illiquid securities with stable portfolios is an extraordinarily difficult thing to do, especially when you want to begin to stratify them on insurer and uninsured and double A underlying and by MBA and so on and so forth. So what we do in the paper, well, one thing we'll point out is that you can't just use average yields. So one thing that you might think is, oh, let's just look at the yields before and after. But the problem is when there's news, the affected bonds trade more, so you get yield information on those, whereas the unaffected bonds don't trade anywhere near as much. So you basically are selecting on which yield is being traded, and so it contaminates lots of your results. So we go sort of deep into this literature, which we're not going to spend. You should read the paper because this part's pretty cool, but we're not going to spend any time on it. And what we do is we basically use a lot of the information, sort of the techniques from real estate to create municipal bond indices, because housing sales are also characteristic dependent and sort of very illiquid. So we sort of modify, we take the starting point, a paper by Spiegel and Starks, which do this for corporate bonds. We have sort of even more illiquidity, so we do some modifications to come up with basically return indices for MBIA insured, AMBAC insured, and also sub-ratings within each one of those. as well as, of course, a benchmark AAA uninsured return index. Here's kind of the big picture of the paper. So right about, I'll just leave. Right here is our distress date. Right here is our distress date. And right about here is where the downgrades happen. And what you can see is that as the downgrades begin to happen, what happens is the yields on the insured bonds begin to diverge really heavily from the sort of uninsured benchmark. Right? And that's the key thing. The interesting thing is that regardless of underlying rating, the portfolio by AMBAC and MBIA, all the way up until the middle of 2008, lays directly on top of the AAA uninsured bond index, as it were. And that in some ways tells you that people are valuing the return. These returns are the same. I don't care whether the insurance wrap has some value. I'm basically trading this bond as if it's a AAA bond. But as soon as the market is blowing up, MBIA is in the papers for having its equity go to $5 a share. I still don't update about whether my insurance is valuable. It's only after the insurance drops to, the ratings go from AAA to AA that we begin to see these things break apart. And we have a sort of a formal mathy test of the divergence of these. Before the distress date, no statistical significance. Between the distress and downgrade date, no statistical significance. As soon as after the downgrade hits, there's a big piece of there obviously you look at the picture, right? So this is the fancy number that quantifies what this picture says. We can plot the difference essentially day by day with sort of standard errors. Again, we generate these standard errors by essentially not just computing the indices once, right? The sort of super complicated, repeat sales regression indices. We don't do that just once. We do that 500 times, and we bootstrap out of that just and create these standard errors. And so the methodology for that is kind of cool, and it's very helpful if you want to do this type of work, and it's all detailed in the paper. So I'll leave it at that. The big point here is nothing happens before the dotted line, and essentially nothing really happens until the other line is actually conveniently right where the screen breaks. So thank you Brookings, right? Like that line is exactly where the downgrade is, and so you can begin to see essentially that line is where they statistically begin to diverge. We look at net order flow to see whether big trades, which we define as above $100,000, are causing small trades, or small traders are leading big traders. And we find a little bit of evidence that the institutions are the ones who do the selling in the post downgrade period, but not at no point in the pre downgrade period. More fanciness. So we set up a causality test to see whether returns in the bond market cause returns in the stock market, or it also might cause returns in the CDS market. We put all three of those things together for each one of these insurers and see whether, hey, do MBIA stock returns lead the information in the underlying portfolio of bonds that they insure? Does AMBAC CDS lead the changes in AMBAC CDS lead the returns in the AMBAC portfolio? And what you can kind of see, the big point here is that the bond, nothing influences them except the other bonds, right? So the stocks and CDS of the underlying insurer don't influence at all over this period the returns on the portfolios in which they insure. There's a little bit of interesting thing, side note that MBIA CDS is kind of the thing that's driving things, partly because we believe that Pershing Square Capital is pushing things around at some point here. There's a number of ways. I mean, that's just the raw numbers. What we're going to say is that we can say fairly confidently, I'm not sure I want to give up a kidney, but I mean fairly confidently that returns on uninsured and insured bonds sort of don't change until the downgrade. And there's a number of explanations. One of the explanations is that insurance never had any value. It didn't have any value at all. Investors were right to ignore it, and so they should have. And if that's the case, we went back though to see how much MBIA and AMBAC were paid over the period from 1995 to 2008, and that number is very big. We have direct evidence they picked up almost $10 billion in insurance in gross premiums over that entire period. That's a lot of money, and based on their sort of coverage of the market from also their annual reports, that implies that the total market is $17 billion in money that was paid into the insurance industry over this period, right? For effectively something that disappeared. There are other explanations, right? It could be that there's no default risk in the muni market. I should be more clear that there's very little default risk in the state general obligation bonds, which are underlying our indices, right? And that's certainly very, very possible. We went back and redid all of the indices and drew a picture with using revenue bonds, right? Because we figured that they have a substantially higher risk of default, and we can kind of. This is the revenue bond picture, which you can see looks almost identical. Again, thank you, Brookings. The line lines up right there. That's the downgrade line, and it lines up. It lines up exactly like you'd expect. So we feel like it's not the fact that there isn't a default risk. It's a financial crisis. So there's a lot of moving parts. Lehman Brothers is going on here, things like that. We study order flow to see who is selling around the Lehman Brothers crisis, and show that there's very little change in order activity around the Lehman. This is a pre-Lehman event, and the downgrade leads Lehman by about 2 to 3 months. So the effects we're picking up are kind of pre-Lehman. It's certainly possible that people knew this and found it very difficult to short the muni market. And express their things. It doesn't sort of explain why you would sell immediately after the downgrade. And if you knew that this was going to happen, it might have been a better idea to sell a little bit earlier, right? So the lack of shorting could have caused something here, but it's not necessarily maybe driving the entire thing. I'm trying to stay on target. Are we doing good? Yeah. Oh, I'm over. Oh, then I'm done. Then I'm done, because I'd really like to hear what Brad has to say. So.
Just slide 9. Can we go to slide 9, please? Great. Hi, my name is Brad Wendt, and one quick disclaimer. I'm talking about these slides in this excellent paper as a capital markets professional of 25 years. Now it is someone who's been at the U.S. Treasury for 5 weeks. So please take it as Brad Wendt, the capital markets practitioner. And when Rich and I had the opportunity to talk to John about the paper, we actually had a lot of fun with John, just because I think there's so many elements to it, and he has such enthusiasm for something that I think you almost have to be a muni geek to have this type of enthusiasm. But I have to hand it to John. His enthusiasm was jumping through the speakerphone. But one thing which Rich and I kind of uncovered, and I think in a way it supports and also kind of contradicts the hypothesis that John has, is the simple fact that he uncovered during a 4-year period what we call a true AAA, in the muni world, either a true AAA, a real AAA, whatever you want to call it, something as, a GO AAA versus insured. For that period, they traded right on top of each other, which, having sat on my share of municipal desks, Rich had the same experience. We just said, how could that possibly be? So what that tells you is there's a point in time in the municipal market where it wasn't that bond insurance had no value, but you could actually argue from your own analysis that it had a tremendous amount of value, and due to the fact that, I think of it as belt and suspenders, where you had the AAA wrap and you had a very solid underlying rating that maybe they actually thought 1 + 1 = 3 in a true AAA. So I thought that was just fascinating research he did. And the next thing, what I want to do is, he used a little of my time, but I think it's more interesting to, no, I'm happy to have him use my time with his enthusiasm. I like his paper, but not as much as he does. But, but the point being that, I almost like to hear from the audience. I have a couple hypotheses why this occurred. And one hypothesis is, we all know about liquidity. Actually, in John's paper, he uses the term QSIP to explain the number of bonds out there. And once again, we tend to think of bond issues at about 1 million, as we know. But in terms of QSIPs that he actually looked at, which is just a subset of all the QSIPs out there, he looked at 3 million QSIPs. So what does that tell you? We're a lot of smart people here, but no one can trade 3 million names. So I think it goes back to one of the hypotheses that the bond insurers have always presented was liquidity. So if you have this water and sewer district in some small town in Iowa, it's a great name. The locals love that credit, but, is a New Yorker going to buy it? Probably not, because of the tax exemption. So you're back to Iowa, and they're going to buy their homegrown product. So I think the point being that the liquidity that bond insurance provided has to, and I'm coming up with reasons why this phenomenon occurred, cannot be discounted, is all I'm saying there. I think it's very interesting that there was a break in the trading value, but the break in the trading value was after the AAAs got downgraded. Obviously, the power of the rating agencies is very, very important when you're dealing with the retail marketplace, and no one at the retail level, with rare exceptions, has the ability to do their own credit analysis. So you really can't fault someone who knows that he or she has a wrap on top. And the one thing, another great paper for you to do retrospectively is, no, I think it's a good idea, but the underwriting of the MBA, FSA, AMBAC, FIDGIC, it was great. And we all know the reason they went down wasn't because of immunity defaults. There's a couple toe stubs out there, and we all know which toe stubs are out there. But the point being, you could almost use bond insurance as a housekeeping seal of approval. So I went out, bought this paper in a water and sewer district in Iowa that no one ever heard of, but I know someone else did a nice job of underwriting. So hence, the fact that it might be upward sticky is another reason. The final thing, and I don't know if we got any hardcore credit experts in here, but I can't remember Moody's or S&P, in terms of what I would call joint ratings, where the famous 1 + 1 = 3. So there, you could actually rationalize it. There is, I understand, in the rating world, if you have a single A here and you have a single A wrap, the combination of those two don't necessarily equal A. It could equal double A. So I just want to throw that out also as a reason for it being upward sticky, is the fact that these things, unlike well, the other graph was the one with the credit default swaps, where they're kind of dropping off a cliff. The dollar price of CDS is pretty high, so it was actually very violent. But remember, when the munis bond insurers were downgraded, they didn't go down to CCC overnight. They obviously went down to AA. So if you think of joint ratings, a AA and a single A, maybe that's pretty good. So I'm just throwing out alternatives. I think it's outstanding research. I certainly don't have the answer, but I certainly like to defer to Rich and the audience in terms of their theories. There definitely is a phenomenon right there during that period of time that the news was out there, the bond market didn't react, and it did react once the rating services formally downgraded the bond insurers. So come up.
Start our Q&A session here. First question, John Chalmers.
Hi, I was curious if you have any of your sample that actually got upgraded from like a single A with insurance that then had a double A underlying with insurance, and you could see if actually the 1 + 1 = -1, or I thought that might be an interesting thing to look at in terms of the information.
Yeah, so that's actually really pretty interesting. The way that we have it set up now, we sort of have the portfolios are constant credit quality. So when you get upgraded, you transition from one index to another, right? So there's a little bit of that going on, but we could look really explicitly at just the changes and see whether that changes the return. So that's a really good suggestion, actually.
Steve Winterstein?
Yes, just a couple of observations. First, I think it was October 29th, 2007, when Moody's announced that they were going to look at the capital requirements of the bond insurers and the capital construct. And then I think it was a couple days later that S&P and then Fitch followed shortly thereafter. So the market, I think, was keenly aware, the institutional market was keenly and acutely aware that there was something going on with the monolines. And we all traced it back to 2004 when GE spun off FGIC to Blackstone. If you can't make a 7% return on capital, then when can you? But I think also there were a confluence of other things that were going on at the same time that I'd be interested in knowing if you've considered these things or maybe you want to account for them. One was, as the ratings on the insurers got downgraded, it force collapsed tender option bond programs, which fed illiquidity in the market. Number two, because of the auction rate problems, dealer firms were not committing the firm's capital. They weren't committing their balance sheet, so they were no longer a bid. So I guess the question, I'll wrap it up by saying, I'm not so sure you can isolate ratings. And we did see things like mass state GOs unenhanced trading cheaper than through mass GO enhanced. In other words, you were being penalized for the same credit, that was wrapped. But there were a confluence of a bunch of things that were going on there, and to isolate them into the value of insurance or not, I think maybe simplifying the problem.
Yeah. There's a lot of activity both by the rating agencies and by the insurers themselves raising capital. There's a number of sort of novation periods. There's a lot of stuff that's going on in exactly this time. And we tried to pick. We have to pick. A downgrade in some ways. We picked the kind of big one, but there was certainly a period. There's certainly a negative outlook for MBIA. And what's interesting is if you look at one of the slides, there's a downtick of the MBI in between the distress and the downgrade date. There's a downtick in MBIA, but not AMBAC, which corresponds very closely to the sort of negative outlook announcement. So we're very sensitive to the fact that there's a lot of other stuff going on here. And it's one of the reasons in a very early draft we had FSA and FGIC and a number of other sort of the other insurers floating around. But because they're not public, it was very difficult to figure out who was doing what and who was taking over pieces of people's portfolios. So we felt like this was the cleanest thing we could. But we're going to agree it's not perfectly clean for sure.
Dan's got a question.
Yeah, so Dan Bergstresser from Brandeis. I love this paper. I'm fascinated by it. I would have, looked in a while ago to some of the divergence between the insured and uninsured, and in what I've seen, and this matched the history of the liquidation of the tender option bond programs and the liquidation of a couple of sort of highly levered muni hedge funds, like the Duration Capital getting liquidated in February. So I'm really surprised because this actually doesn't match my priors about where you would have seen the break point, which I would have put at maybe February 12th, 13th, rather than August. And so I'm curious about digging in on exactly where you're finding the break point, which was more in the August.
The break point, I mean, if we were just going to let the data sort of tell us where the things break apart, it would probably be sometime I would say I talk loud anyway, so but it would probably be sometime in July to early August I would say late July of things, sort of right. But there's movement right after the downgrade. It's, there's like I said, there's a tick in MBIA sometime in February, March, and the tender auction bond thing could be doing that, but it could also be the negative outlook thing. There's like a number of things that all stack up in late February thing. And so like I said, we picked 2 dates, and like I said, we tried to keep as much of a gap between them so we could see what we could see.
So reminiscent of Dan's skin in the game. Kim,
And we cite your paper too.
Kim, did you want to add something to that, Kim? No. Okay. Great. Okay. Other questions? So I did have a question. I'm wondering if we would see the same phenomenon in the other insured markets,
Such as
the ABS market.
ABS market. I honestly don't know. I don't have.
My sense is that's a
I don't
more
know.
sophisticated market, if you will. But
But-
the
We do know that the financial guarantors
it's less
did
sophisticated.
a very. I agree with Brad's that the financial insurers did a really good job of underwriting municipal business. It's fairly clear in retrospect that they did a exceptionally poor job of underwriting insurance on structured products. They were very late to the game. They jump in, and as I was talking to someone earlier today, you can see they're in their annual reports. There's a line in AMBAC's annual report where they report the value of their CDS, and it's $10 million market value, and then 1 year it's negative $6 billion, and so it jumps from 10 million to negative 6 in 1 year, and it seems to me that that's a revaluation of entire methodology, not just market values. So
There are some that argue, though, that the ratings agencies actually force them to diversify their revenue stream. I'm sorry. Kim will know. We've long had sort of less confidence in rating agencies than many people have. So there's certainly is sort of, I think, room to say who's doing a good job. But back to the original. I'm not convinced. It would be interesting. I don't know. Getting insurance data on structured products would be very, very difficult, I think.
those migrations seem to be extremely rapid, like in a day. So.
We can find the CDO portfolio, but not the RMBS portfolio.
Right. And on the ABS, I think it's a neat idea, Rich. Then you're away from a retail marketplace.
Right.
So
Yeah,
I would think it'd be
Really good idea.
fascinating to see if it just dropped off the cliff. But once again, getting back to the retail investor, and I love your paper, but almost sounds like since they didn't sell, that they were not observing events out there. When you look at that, when you look at that slide, which is my favorite slide, slide 9. If you're a retail investor, you're preservation of capital. And according to that slide 9, with those returns, there's a little gap, but everyone's still paying their grocery bills off of that interest income. So it's I think one thing I would point to is more emphasis on the fact who was the end holder of munis, which are obviously vastly individuals.
I think we're going to have time for one more
Yeah,
question.
I guess related, and I apologize, I haven't read the paper. Oh, I'm sorry.
Tell us your affiliation.
Oh, Carolyn Walsh, I'm with Steptoe and Johnson. I guess I'm wondering also that you focus on MBIA and AMBAC, and would your results have been any different? Or if you look, why did you exclude Assured Guarantee? Who performed differently during the crisis?
Yes. So we had some in an earlier draft. With Assured in it. Part of the problem is Assured. The bonds that Assured trade pre-crisis are very, very, very sparse. So the bonds that were insured by Assured are very, very, very sparse. So it's very difficult to create the sort of portfolio index for Assured in the pre-crisis period. Once they get almost the entire market, it's very, very we can do that, but we need to have the whole period. So in a lot of ways, it's a data sparseness thing. It's nothing we wanted to do. In fact, our original sort of picture was, if you look at Assured stock price, it stays almost constant. So we wanted to show the picture where MBIA and AMBAC drop off and Assured stays very solvent through things, and we wanted to show the portfolio of Assured, but it was very, very hard to construct the Assured bond return portfolios.
Brad, do you have any last comments?
No, I thought it was a great paper. I
great.
really enjoyed reading it.
All right, I'm gonna leave it at that to give us time to transition.
I do want to say one thing that I want to thank Brad, and it kind of, he points out, I think, one of the biggest pieces that we don't address here, which is liquidity. And we don't talk very much about it. I kind of want to we're going to put a quick commercial. We're also trying to write a liquidity paper that I sent to Brad. And so I was just going to say, if you have any thoughts about that, we'd be really happy to get them.
Well, we're certainly trying to match practitioners with academics. So if anybody wants to throw in with John and Kim, please do.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.